Don't time the market. You've heard that 1,000 times. But what if I told you that when it comes to inherited IRAs, that advice could cost you hundreds of thousands of dollars? Well, today, we're flipping the conversation. We're flipping the conventional wisdom on its head, and we're going to show you why market downturns might be your greatest wealth building opportunity.
Welcome to Leibel on Fire with Amazon best-selling author and Yields for You portfolio manager, Leibel Sternbach. Leibel on Fire is supported by our ETFs, Yields for You Strategy A and Relative Strength Manage Volatility. Our mission is to help 1 million people retire with financial security. Now, the financial independence and retirement show dedicated to helping you build the life of your dreams as fast as possible with as little stress as possible. It's Leibel on Fire.
Hello again and welcome to Leibel on Fire. I'm excited to be joined by Leibel Sternbach. He's Amazon's best-selling author on the book entitled Living with Financial Anxiety and also the book Authenticity. He has a wonderful website also entitled yields4u.com. Yields, the number 4, the letter U.com. Leibel Sternbach, I'm glad to be talking with you today.
Hey, how are you today?
Unbelievable. I still got a little froggy happening in my throat, but we're not going to let that bother us because I'm really interested in don't time the market. And for years, you've told us that we can't do that, but it could be a little nuance. So why doesn't that rule apply to inherited IRAs? That sounds almost like you're talking heresy here, man.
Yeah, it's when it comes to taxes, right? So you got investment advice and you got tax advice, right? And something that we like talking about on the show is that, when you look at the tax code really informs what you should do and how you should do it. And it's one of the great things about our country, right? It's what makes America great. It's what makes our economy great. It's why we drive the global economy, is because it's the thing that we've figured out as a country, as a nation. And so when we talk about timing the market, usually that's in the context of the question of, should I sit on cash and should I wait until the market drops before I buy? And when you're thinking about the question of, I want to make a profit on a future drop, well, you can't really time the market in that regard because statistically you're going to be wrong, right? There's JP Morgan does a study every year on timing the market, and they show that if you miss out on the 10 best days of the market, you basically miss out on all the returns. So when we're talking about growth, right, and when we're talking about when you're in your 20s and your 30s and your 40s and even your 50s, right, you don't want to be timing the market from the perspective of, I want to get a deal, I'm making money. What you do want to be timing the market for is two things. One, protecting your money, and number two is taxes, right? So statistically, we know market corrections happen, right? It is a phenomenon about the markets, right? They don't just go up in a straight line. If they went up in a straight line, it would be a savings account, right? There would be no risk involved. So the risk in the market is that it can go down, right? It could be that the price is wrong, right? It could be that it's overvalued. These things happen, right? It's a natural product of how the markets work. It's called price discovery, right? You have a bunch of people who think the market is great and think that, the future is all rosy. And then you have a group of people who think that, the sky is falling. And together they figure out where the market really should be. Those things happen with a statistical probability, right? We can pretty much predict how frequently they happen. We don't know how strong they'll happen, right? But we know approximately statistically that every 3.5 months there's a 5% correction. We know that every 18 months there's going to be a 10% correction. And we know that approximately every 3.5 years there's going to be a 20% correction or greater. And because we know these things, and because we know that stocks go up and down, and it's never 100% of the stocks are going up or 100% of the stocks are going down, we can then use that to our advantage to be able to time when we take distributions or when we do things like tax loss harvesting, where we take advantage of those temporary market volatility to get ourselves a discount on our taxes.
So am I understanding this correctly? You're saying that when the market drops, we should actually be taking money out of our inherited IRAs? Walk me through this. I want to make sure I'm making sense of this.
Yeah. So think about it as, you got a Black Friday sale, you got, the Christmas sale, right? New Year's sale. And then you've got all the sales after the sales when there's like, we didn't get our sales numbers. So these sales, right? In the retail world, they're trying to drive, they're trying to drive bargains. They're trying to drive, people to purchase things. So they reduce the price. It's going to happen, right? Everyone knows there's going to be a Black Friday sale, right? Mm-hmm. You buy that TV, right? You're going to get, a 20% discount on it, right? So, well, if you're going to buy a new TV, maybe wait a week for that price to drop by 20% and then buy the TV, right? So it's the same thing when it comes to our inherited IRAs or our same for doing Roth conversions. Same for doing tax loss harvesting is, well, when the market goes down, all of a sudden the tax bill for doing that conversion, you can look at it one of two ways. Either the tax bill has gone down by 5, 10, 20, 30, 50%, right? Or you can look at it as I get to convert 10, 20, 30, 50% more than I would have at the same price. Either way, it's a win for you because especially with inherited IRAs, that you've got 10 years to make this account go to zero, right? So when do you want to do it? You want to do it at the high point, at the low point. You want to do it when you're getting a discount on that conversion and you get to theoretically convert less or to distribute less, or you want to do it when you have the most amount of money, right? I don't know about you, but I hate paying Uncle Sam. So I will do it when I pay the least amount of money to Uncle Sam. So yes, you want to absolutely time the market. And by timing the market, you can save yourself so much money, right? An incredible amount of money just by waiting for the right opportunity. And not to change the subject, but there's investment opportunities that come along with that, right? When we're talking about our retirement years, right? Where we're not so focused on the growth and we're worried about income and we want protection on our investments. Well, yeah, we can't time the market on the upside on the growth, but we can absolutely time when the market is going down. And all of a sudden, those things that have protection, they price better because there's a higher probability that the market's going to go recover and that there's going to be a greater high point after that, which means if we want protected growth, whether that's in the form of fixed income annuities, whether you believe in them or not, or products that price similarly to them. There's lots of products out there that are not annuities that offer similar protections. And when that market dip occurs, they price better and you're able to get much better returns on them, or hypothetical returns, theoretical returns, than you would if you just did it at any other point in the market.
Leibel, I don't mean to debate with you here, but you're timing the market, but the market does not creep along. No. You could wake up today and all of a sudden the bottom has fallen out. So yes. How does anybody effectively execute on something like this?
You got to be prepared. That is the only answer. You got to be prepared. You got to be waiting for it to happen. And you got to be ready to snap your fingers and make that transaction occur. Because by the time you make the decision for that transaction to occur, the opportunity may be over. Right. And so that is no time. Yeah. So you got to be ready to go, which is why with our clients, right, that's why we manage their accounts. It's not because we're doing any kind of crazy investment strategy. Everything we do, you can do in your own accounts. But the thing that we do that you can't do in your own accounts is when the market goes down and we see that going down during the day, we can click a button and move it over and do that Roth conversion. We can click a button and do that tax loss harvesting at the best opportunity, which is very difficult for if we send you an email, then you get it. Maybe you get it during the day. Maybe you get it after recovered. Maybe you don't see it for 3 days and then all of a sudden the opportunity is gone. And so you need to be ready to take advantage of that opportunity when it happens. Otherwise, you will miss the boat.
What's the biggest mistake that you see people making when they're trying to negotiate with their inherited IRA? And I'm thinking I may already have the answer. They're sleeping at the wheel, or is it something different?
No, it's failure to plan, right? They say failure to plan is planning to fail. When it comes to the government, failure to plan means you're partnering with the government, right? The government is in the driver's seat. And we all know that the government does not have our best interest in mind, right? We're just a number to them. We're a rounding error to them. And so when it comes to, inherited IRAs, whether it's regular retirement accounts or it's inherited. If we do not plan, the government's going to plan for us. And I can guarantee you, almost virtually guarantee you, that the outcome will be in favor of the government and not yourself. All right. So you want to make sure to make those decisions, actively make those decisions. And listen, that decision may be, I don't need to do anything. But that is, again, a decision that you're actively making and that you need to reevaluate, because circumstances change, your investments change, your account values change, tax codes change. You need to reevaluate that on a regular basis, even if it is, hey, I'm okay. I don't have to do a Roth conversion. I can just do the RMDs. That is still an active decision that you need to make. Otherwise, the government's going to reach into your back pocket and you will have nothing left but when all is said and done.
Thanks for scaring me, Leibel. So, at yieldsforyou.com, I've got that bookmarked in my browser. What do you have anything there for us that will help us along in this process?
Yeah, absolutely. You will hear me say this over and over and over again, right? Just reach out to our team. We do free retirement and tax SWOT analysis where we take a look and we look at your strengths, your weaknesses, your opportunities and threats. And the biggest thing that we do is we map this out, right? Because we look at where you are today, we project out what the future is going to look like, and we tell you what are the things that we see as being those low-hanging fruits that you need to take advantage of. Whether it is, doing these Roth conversions or the timing of the, distributions from the inherited IRAs, right? You need to have that plan in place beforehand. You need to know what applies to you so you can take advantage of it. Otherwise, by time it comes up and you're looking and it's like coming up December 31st and you're like, I don't have any time left and I just need to do it. Well, then that's when you lose, right? It's the traders and the planners who have the plan beforehand, who know clearly what their on-ramp and off-ramp is. Those are the people who win. Everyone else is catching up and playing in their world.
Well, we're going to avoid that, and I'll redirect you again to yieldsforyou.com. That's yields, the number 4, the letter U.com. And unfortunately, that's all the time we have for this episode. And the next time we get together, we'll talk about the 2025 estate tax cliff and why the next 12 months could be the most consequential for you in planning in this window of your lifetime and what you need to do before the exemption gets cut in half. That's Leibel on Fire. I'm Freddie Bell, and we'll see you next time.
If you would like to see how the Yields for You team can help you get off the Wall Street roller coaster and save you money on taxes so you can live the life of your dreams, book an appointment online at yieldsforyou.com or call 410-914-4894.
Yields for You is a registered investment advisor in the state of New York and only transacts business in states where the firm is properly registered or is excluded or exempted from registration requirements. Registration as an investment advisor is not an endorsement. Information presented on this program is believed to be factual and up to date, but we do not guarantee its accuracy, and it should not be regarded as a complete analysis of the subjects discussed. Discussion should not be construed as an offer to buy or sell or solicitation of any offer to buy or sell the investments mentioned. Annuity guarantees are subject to the claims paying ability of the issuing insurance company. Content should not be viewed as legal or tax advice. Always consult an attorney or tax professional regarding your specific legal or tax situation.